Hello everyone, my name is Amit Partwaj. I'm a mortgage and protection advisor at First Call for Mortgages UK Limited. We have access to whole of market products. Today I'm going to talk about why employment income is more favorable than self-employed income and what are the key components in the perspective of the lender. So why wait? Here is the quick summary. Employment income is generally considered more favorable than self-employed income in the mortgage process in the UK due to several factors. Number one, stability and consistency. Lenders often prefer employment income because it is perceived as more stable and consistent. Employed individuals typically have a regular salary and may have a steady employment history, making it easier for lenders to assess their ability to repay the mortgage. Self employed individuals, on the other hand, may influence fluctuations in income, making it harder for lenders to predict future earnings. So, here the key take is what the lender thinks. So, uh, fortunately or unfortunately, uh, we need to understand that it's not what we think. It's always about what lenders think because they are the one who is going to uh, fulfill your the dream of buying your first home or your second home, depending on which stage in life you are at in for property buying process. Number two, verification and documentation. Employment income is relatively easier to verify and document compared to self-employed income. Employees can provide payslips, employment contracts, and bank statements to demonstrate their income and employment stability. Self employed individuals, however, need to provide business accounts, tax returns, and other financial documentation, which can be more complex and time consuming to assess. Number three, risk assessment. Lenders consider self employed individuals to be higher risk due to the inherent uncertainties of self employment. Self employed individuals may face challenges such as irregular income, business expenses, and potential fluctuations in the market. Lenders may require a longer track record of self employment or evidence of consistent income before considering a mortgage application. For example, um, somebody who was employed and then became self employed, and their employment income was, let's say, X amount, and lender was happy with it if they were currently in the employment, but now they are self-employed, and the mix of income makes it harder for the lender to make a lending decision whether to lend to the applicant or whether it is not whether not lending it to the, because you do not have enough track record, and more likely it's minimum 2 years and the lower of the average, and the lowest in the last 2 years. So it depends on each lender, and then they make the decision based on their own criteria. Number four, affordability calculation. Lenders use affordability calculations to assess the borrower's ability to repay the mortgage. When calculating affordability, employment individuals generally have a straightforward income calculation based on their salary. However, self-employed income requires a more detailed analysis of business profits, retained earnings, and other financial factors, which can introduce more complexity and uncertainty into the affordability assessment. It's worth noting that self-employed individuals can still obtain mortgages in the UK, but they may face additional scrutiny and requirements compared to employed applicants. Lenders may request a longer track record of self-employment, higher deposit amounts For example, it is 40 most of the self-employed, it's 40% LTV or additional financial documentations to mitigate the perceived risks associated with the self-employed income. So if you are self-employed and seeking professional advice from a mortgage advisor, why not contact me on 07886 I am running a 15 minutes free session to help you. And if you like this video, please leave your comments and your feedback so I can improve this content further. I see you next time. Have a nice day.